Joining me now, back at Post 9, VantageRock's Avery Sheffield. Welcome back.
Great to be here.
So you're not as bullish as some of the others who've been on the program here before you today.
No, I'm not. I mean, the market is expensive, right? 21 and a half times for the S&P, 28 times for the NASDAQ. Cyclically adjusted, Case-Shiller, 35 times. It's actually almost the second highest. It's been back to the late 1800s. You have put-call ratios expressing extreme bullishness. This is a market where people are excited, as your previous guests, who I greatly respect, I think demonstrate people are excited. And when everyone's on one side, I always wonder, is this really as good as, is it really going to be able to go further from here?
And you really feel like everybody is sort of now on one side of the boat?
It feels like, I mean, valuations would suggest that. Sentiment would suggest that. But call ratios would suggest that.
Yeah.
I feel very much like a lone, more cautious investor at the moment.
Well, I mean, there are reasons to be bullish, no? That's what they say. Fed's cutting. Economy's much stronger at this point than people thought it would be. And we're just at the first stop on the train tracks of these cuts. Right.
Well, the question is what's priced in, right? So if we look back at, go back to where the market bottomed. The market bottomed at the end of October 2022. We were worried about the economy getting worse and the Fed having to cut at some point. We had infrastructure spending ahead. We had onshoring spending ahead. We had AI excitement ahead of us. The market was at 15 times then. Here we are, 2 years later, market's at 21 and a half times, and AI spending has already massively taken off. Going to continue
it's not
to be
over.
Strong. It's not over, but is it accelerating from here?
Spending?
Spending accelerating.
Maybe.
Growing at a faster pace than it's grown so far. I'm not sure it's going to grow at a faster pace. It's going to continue to grow a lot. There are going to be a lot of dollars, but is it going to grow at a faster pace than it's grown? I don't know. Are we going to see infrastructure spending grow at an accelerated rate from here versus what we've seen over the past couple of years? From what I'm seeing, it looks to be more stable, right? And then in terms of Fed rate cuts, yes, we are here with rate cuts, which should be stimulatory. The only reason it's taken this long is because the economy's been better.
Yeah, for good reasons.
For good reasons. But what we've had is the market front run those rate cuts, right? So you look at many industrial stocks, you look at stocks in the housing sector, you look at stocks in trucking. They're trading at near all-time highs on potentially depressed earnings with the expectation that rate cuts are justify the valuations. But then when you get those rate cuts, how much upside is there to the stocks from there?
Okay, so you think a lot of it is just in the market. What areas of the market do you like? Because when you sat down and you said you kind of uncomfortably the bear out of the group thus far on the show, it's not like I don't like anything, but what do you like?
Yes. Well, I mean, we tend to have more of a barbell approach to our portfolio where you have kind of those steady, kind of compounding ballast positions, reasonably priced, not as cyclical, and then cyclical opportunities. So on the kind of more ballast side, we continue to like the telecommunications companies. I don't think many people are aware that actually you've had two of the major wireless carriers in the U.S. Their stocks are up around 30% this year. Like, they've massively outperformed the market, but they're still quite cheap at 7 to 10% free cash flow.
They did underperform prior to that, didn't they?
But the whole point is, what has been the opportunity for this year and what's the opportunity from here? And I think people are really underappreciating how this industry has become more consolidated. Family plans are creating a stickiness factor where they're not having to spend as much to keep you. Churn is coming down. And also each of them has a secular growth story, whether it's fixed wireless or fiber. That has a high ROI for them to build out their broadband businesses over time. Look, very slow growth, but just way too cheap. Solid, steady businesses. If rates are coming down, where can you get a 7 to 10% return to shareholders every year? So we like that. We also like areas in cyclicals. So we're more cautious on cyclicals that we feel like are pricey in a lot of Fed cuts. But there are still areas of cyclicals that are very cheap.